All right. Good morning, rhinos. Let's go ahead and pause this music. Why does my camera look like it's... See, I have a stand, and this stand requires me to play with it every single day. And the stand's going to end up out a window one of these days. Cool. All right, let's get to it. All right, welcome. Get in. We will take some time together. We will have so much fun. And we'll see what's going on, right? So let's let everyone get in before we get started. I'll maybe take a sip of water, and we'll give it a minute or two. All right. Oh, Don, happy day, team. Don is the best. Really, really great. Frida, I see Frida's in here 2 times. And that just means we're doubly as fun, which is totally cool. All right. All right, so we have a really good group over the end. We'll let that be for now. Anyone else that's joining us, great. I think today we're going to go more towards charting and more towards sharing that, more towards actually taking a look under the hood and seeing what's going on in the market as we speak. Because let's give a little bit of a, we always want to go ahead and follow up on what we did the day before so we can make it nice and cohesive, right? Learning is not just, okay, what's going on today? You have to know what happened yesterday to be able to take a look forward to what you think might happen tomorrow. And all the while, you need to go ahead and just or take a look at it today and say, okay, this is what I believed was going to happen today. So my interpretation of events is correct, right? Or I did not see today coming, therefore my interpretations of events has been incorrect. How can I go ahead and correct that? So just because you don't make a move on any given day doesn't mean that you're not doing something. You're always working. You always have to be moving forward. And what I mean by that is, so for instance, let's go ahead and take it to an actual real world, right? Like, what have we been doing? We haven't bought anything in a week. In fact, we said we really wanted to buy something today. In fact, yesterday we sat here and looked at 2 different stocks and said we really wish we were here earlier to have bought it. Now, in all fairness, I was driving in. I did know the stock price of loosened under 26. It got down to 25.90. Because if you were with us yesterday, you understood that the stock got a, we went ahead and shared what the prospects of electronic vehicles are in terms of the valuations of the company, which you only were able to make a decision on based on the valuations of the markets, right? So the market is a whole bunch of participants that at any given time have an individual investor sentiment and investor behavior that goes ahead and values everything accordingly. Because the one thing you need to know about the market is companies trade on earnings. Companies trade on multiples of earnings. For instance, a company that makes $100, the stock doesn't sell for $100. It sells for many multiples more because the belief is, all right, if they're able to make $100 this year, they'll make more next year, and maybe they'll grow next year. And if I put my money in this company and I'm able to make all my money back in 5 years, well, then every year thereafter, everything's all gravy. So if it's making this much per year and has this growth rate, and if I buy it here, considerably these earnings will compound and I'll make my money back within 10 years. And then this is my growth going forward. Great, I'll buy this company. That company is now, it is not valued on what it's worth today. It's valued on what you believe it's going to be worth 10 years from now. And that line is how long it takes you to get your money back. So in a really super duper exciting market, different valuations are really high because money's free. There's nowhere else to put it. So you start saying, okay, well, I can't put money on bonds. It's 0%. I can't put money here, and here. There's only really one place to put the money, and that's in the stock market. Therefore, I usually wouldn't buy a stock that doesn't return my money in 10 years. But since there's nowhere else, I guess I'll buy a stock that returns my money in 12 years or 13 years. You're constantly looking for the best place to place your money. Everything in investment is relative. This investment is a good or bad one only relative to a different one. No investment is good or bad in a vacuum by itself. Therefore, money flow is always constantly comparing 2 things. So when someone says, oh, well, 10 years ago, the market was selling at this multiple, that's a sentence that's reserved for someone that either knows nothing or they don't know that they know nothing. Because for me to even comprehend what that means, I have to know so many variables of what was going on 10 years from now to even approach the notion that I could possibly even imagine investor sentiments at that moment of why the price to earnings multiple was only 10 rather than 12, rather than 8, right? What was the politics? What were new bills coming out? What were new bills that were rumored to come out? What were new bills that were rumored to come out? What was tax consequences? What was the tax consequences rumored? Who was in charge of what? Who was friends with who? What company all of a sudden was a monopoly? What company bought out what? What company was rumored to buy this out? What was the bond yields? What was the currency yields? What was the transactional cost? Tell me all of that stuff and I could maybe understand why a price to earnings multiple of 10 years ago was even relevant to a conversation, right? So there's a lot that goes into it. And what that means for us is yesterday we sat here and said, okay, if we believe that the market is going to move higher over the course of the next year, 5 years, 10 years, 20 years, because we believe the initial decision of where to put money is so overtly obvious that you would never put it in government bonds, you would then move it over to corporate America. Well, now it just comes down to a price point. Where does the market stop going down? Where can you get into it where you could start living it going up? Now, that's a very tactical assessment, right? So for someone that says, Ant, I'm not trading in and out of stocks on a daily basis. I'm just looking to know that if I put my money here, it's the right decision 5, 10 years from now. In that case, that individual has been buying nonstop and should be buying nonstop. And then you have the individual who says, Ant, you know what? A volatile market's a good market. That means things go up, things go down. And I've seen you make money on buying calls. So you were buying options that go up. And I've seen you buy money on buying puts, options that go up when the market goes down. I've seen you go left. I've seen you go right. I've seen you go both ways. I know that a volatile market allows you to maneuver because you have a maneuverability that's agnostic to direction. It's simply just velocity. Yeah, I think that's well said, Anthony, about Anthony, right? That being the case, so what happened? So yesterday we came into the market was down at the beginning of the day. A lot of the stocks that we were looking at were down. And we said, okay, Facebook has to stop going down for us to have a certain confidence in this market. Facebook got down to 216 yesterday. In fact, that was, I think, around 1 o'clock because I actually tuned in and I saw it at that exact moment. And I really thought to myself, I'm like, kind of want to buy some Facebook here and then I'll post it in the group that we bought Facebook. But I didn't because it was just going down. I don't know when it's going to stop. The person that makes the most money in the market is the person that gambles. That's true. That person makes the most money. Let me rephrase that. The person that makes the most money in the market is the person that luckily and successfully gambled, right? Because when the stock's going down, everyone's buying it. Okay, I got the bottom. It's going to go up from here. It's going to go up from here. Facebook was $330. Yesterday was $216. That's almost $400 billion in market cap. The company is now worth under $600 billion. It was just worth $1 trillion back in 2020. That's a lot of money. That means the company as a value went down 40%. That means the company lost $400 billion in value. Do you know how large $400 billion is? It's very large. It's larger than half the countries in this globe. It's larger than like 75% of the countries in this globe. That's a lot. All along that way, what do you think people thought? I'm going to buy it here. It's going to stop going down. In fact, after they reported earnings and got annihilated, the stock was 250. 250 is a nice round number. Do you know how many people bought at 250 and said, all right, I'll buy here. It went down 80 points. It's Facebook. It's going to go back up. So the stock went down to 245. You know how many people then bought there? All right, I'll cost it. I bought some at 250. I'll buy some at 245. Then went to 240, then to 235, then to 230, then to 225, then to 220, then to 216. The point is, at some point, assuming the company doesn't go to zero, somebody's going to be right. And that person would have bought in the most pessimistic situation, right? It just keeps going down. It's going down. It's going down. So they're not going to buy something that already has a value of the belief that it's going to go up, right? So they're going to buy it very cheap. And they're going to buy it by definition at the best point, because it's done going down. How do you identify that part? How do you identify that point? You can't. There is no way. You have to literally be a gambler. You have to say, I'm going to do this so many times, and the goal is that I just don't lose all of my money, so that the one time it does hit, I really hit it good. In which case, we could have been that person. Yesterday, I did see the stock at 216.72. And I thought to myself, I want to buy it. Now, would it have been luck or skill that I would have bought it at the exact bottom? It would have been luck. Sure, skill puts you in a position to be lucky, right? Like, I'm going to be lucky more times than, say, somebody that's just new to the game. But that doesn't mean that I would have got it right. It means I would have got lucky. There's no way in God's green earth would I have been able to know without a shadow of a doubt that a stock that was at 225 earlier in the day, that's now down to 216, the exact second I look at it, is that going to go down to 215 or 214 or continue going down? You just couldn't know it. You could say, well, Ann, it went down so far, it had to have a bounce. Yeah, that's true. But that doesn't tell me the number it's going to bounce at. It just tells me at some point it's going to bounce. Well, in the real world, you have to be correct. It's only when you're a stock analyst, a political consultant, a weatherman, a news anchor. Only when you're like one of those people, you're allowed to be wrong nonstop. And then people still watch, right? Like if your job is just being a political consultant and trying to confuse a whole population and trick them with words while you're getting paid from political action communities and PACs that are government or corporate lobbyists, you could be wrong as many times as you want. The money you're getting is fake, right? It's just taking it from corporate America that's paying you for deals down the road, right? Those people can be wrong as many times as they'd like. In the real world, real people that make real decisions cannot be wrong like that. So I can't go ahead and jump into a stock at 216 just because my heart says, oh my God, it's down to 216. For the same reasons, okay. So for the same reasons, we have to understand what it is that we're looking at, how we can be right and how we can be wrong. So something very valuable did happen, right? So if you ask me right now, and do you regret not purchasing Lucid under 26? Do you regret not purchasing Facebook at 216? Do you regret, I suspect PayPal's probably up, not purchasing PayPal. I think it was at like 116 or something. The answer is yes. And the answer is yes, because now we know what it is. Without a shadow of a doubt, it's a completely it's completely, whatever. What's the word? Not objectionable, it's completely, whatever. It's completely proven, it's complete fact, right now the stock is the price that the stock is. Meaning, if you purchased the stock at a lesser price and you sold it at a higher price, it's complete fact that you made money. So it does not matter why you did or did not do it. It's okay to say, do I regret not buying the stock? And the answer is yes. To say otherwise is silly, right? Because there's a profit. We could have had the profit. But why didn't we buy the stock? Because we needed the market to tell us something. We saw an EV company, electronic vehicle, that's not going to make a profit for God knows how long in an environment where everyone believes rates are going to rise. Therefore, their borrowing costs can continue to go higher. Therefore, by every balance sheet, business plan metric, this company is worth zero. In fact, the company is going to be continually worth less than zero because they're going to have to continue to have new investment to just fund the idea that maybe one day they're profitable. But we said, well, a profitable company like GM or Ford that needs to get into the electronic vehicle space likely would want to go ahead and purchase one of these companies. And if that's the case, both things could be true. This company by itself could go to zero, and GM or Ford can go ahead and buy it at a premium because they know they need to get in on that space because electronic vehicles are the future. Because for a company like GM or Ford to get into electric vehicles, they have to do what? They have to identify the talent. They have to identify the expertise. They have to go ahead and hire these people. They got to get them on contract. They got to build the factories. They got to build the teams. They got to put a game plan together. They got to put projections here. They have so much stuff they have to do, and that costs money. So to go ahead and say that company is worth zero, but it's worth more than zero to them, Both are true sentences, because for them to get as far as they even got, it's going to cost money to do so. Therefore, the money that it would cost to do so would behoove them to just go buy them at a rate and at a price that they believe is a good price, because they have an insight to the future. They have an insight to what vehicle demand is going to be. They have an insight to what bond yields are. They have an insight to all of that, plus they have a balance sheet, which means two things could be true. This company's worth zero, and this company's worth more than zero to somebody. Now, therefore, the company's never going to get to zero because it's worth more than zero to somebody. So what's the price that to somebody is willing to step in and buy it? Well, we don't know it, but what is that price that the market believes it's going to be? Well, we could start gauging that, because if this stock does not go to zero and it stops going down, but it actually starts going up, we start getting to a point where market participants are saying, and they're using their money, they're voting with their money and saying, I want to own this here because I believe owning it here, I have a certain floor because I've done the math, and I believe that they would go ahead and buy this company near where I am, if not higher. So we don't need to know that to be true, but we can see it and we can interpret it. Nobody that buys a stock is going to tell you the real reason they bought a stock. They bought it for the reasons they bought it. And in fact, they're going to tell you reasons that are probably hyperbolic so that you buy it, because when people buy stocks, they go up. So if I own a stock and I want to pump a stock, I will tell people to buy the stock. Then I will go to jail for doing that because that's illegal. But the point is, that's what people do on a very small scale, like Reddit, right? Like remember in 2020, everyone wanted to buy stocks, everyone piled into the same stock. That's basically what that is. So we said that. And then we said, oh my God, JP Morgan came out and slashed them, said, I would sell them here, that the whole vehicle space is bumpkiss, that it's too early to get into these stocks, and that their valuations are too high, that the stocks need to go down. We were right here. We shared this together yesterday. And what happened? The stock opened up down 4%. And we said right here, we're not going to buy it here because now it's only down 1%. We liked it before. Let's watch. Because now we have a moment where the market can tell us something. Here's what the market can tell us. There is a stock that is worth zero, but it's worth more than zero to somebody. Now a big bank comes out after the stock is already a 16 red and green, so it's been coming down for a while, and they say, we go ahead and we would sell this here. We're putting a sell on it. We're saying that this is not a good stock. And conceivably, people listen to them. They're the analyst community. You always follow your analysts, right? So the stock started down 4%. And we said, if this stock goes up on bad news, then effectively, all the bad news is priced into it. Effectively, it has gone down so low that it is discounted so much bad that even this really, really super duper big Wall Street note from the biggest Wall Street firm coming out and placing a sell and saying this is a POS type of stock, if it could price in that and go up on that news, then what would it look like if it got good news, right? So we were able to watch, and we're still watching. We're going to take a look at it in a moment. But if it's up, what did that tell us? That things are really at a point that even the bad news is priced in. That even stocks that are theoretically worth zero, that are being told to be sold, are going up. And if that's the case, well, then what does that mean about the market? It means that the market has found that footing, that money is coming back in and saying, listen, I don't really care what you guys think. Here's where I'm getting in, and I'm willing to defend it. And if it goes low, I will buy more because I'm starting to buy here. Now, of course, that doesn't discount a cataclysmic event, right? Like if something really, really bad happens and it's something new that no one did not know was going to happen, well, that's a new reason to sell stuff, right? Like we don't know what we don't know. So that's why we take a look at the markets, why we take a look at the charts, why we take a look at the volume, so we can start sniffing out if other people know something we don't, then we want to be aware of it. But we don't know what we don't know, right? Like if the White House gets blown up tomorrow, I suspect stocks will go down. I don't know that to be true. I don't know if that's going to happen. No one told me that's going to happen because I would go to the authorities because that'd be treason otherwise, right? So let's just say that out loud. But if that were to happen, the market would go down. Therefore, it doesn't matter about electric vehicles. That being said, the belief is everything that is known is priced in, and money's coming back. So is that an all clear sign? Does that mean we could just go in and buy stock? I don't know. We got to see. But it's a very, very good sign, because if PayPal stopped going down, and we made the same argument with PayPal as we did with electric vehicles, in terms of electric vehicles going to big automakers and PayPal going to large banks that need that, right? So if PayPal stops going down and is now going up, if electric vehicles stopped going down and are now going up, and if Facebook finally stops going down and is going up, that is a really good sign. That means these things hit a bottom. And well, a temporary bottom, which actually means nothing, because if it's temporary, it could go lower. So why did you even say it, right? But the reason I mentioned it to you is it's like 2 weeks ago. Remember that Monday where the market was down 1,100 points and it rallied? It ended the day plus 100. We said that was the best thing that ever happened, because it was called a capitulation day. It came all the way down to 1,100 and rallied up. But what it allowed was professional money managers to feel comfortable getting back in the market, because now they had a reference point. Again, when you're a professional money manager, you are not afraid to lose money, right? You get into this game, you understand there's going to be times you make money, and you're going to understand there's times you're going to lose. That's no. It's a matter of if you can quantify that risk. So if I see that a market came down 1,100 points and went up 100 at the end of the day, I can say, okay, great. That conceivably was the bottom. Look how many people bought. In fact, they bought so much that it rallied the market back. Whether that's the bottom or not, I have a reference point, which means I can buy anything I want and say, if that number goes under that number, then I'm selling it, because obviously that wasn't the bottom. But if that was the bottom, conceivably anything I own is only going to go up from here. So I can cap my losses at 2-3%, whatever that number was, and I could unleash my profit potential to infinite, because numbers can go as high as they can go. It's infinite. So if I could go ahead and cap my downside to 3% and allow my upside to run to 20% as a professional money manager, what do? Well, you do it. You go call your clients, you raise money, and you start buying stock. And that's what we saw. That is what we said. That is what we made money on, right? Like, we all know this. We've been together. We did this in real time, which so makes RHINO different. We see it, we say it, and it happens. And it's not that we know more than anyone else. It's not like God himself comes down and tells us this stuff, but there's a certain level of experience and logic that when you can look at something and say, okay, this is what's happening, right? So what we're looking at now is we have reference points again, meaning anyone could go buy PayPal, and if it goes under yesterday's low, you sell it, which means you have a downside protection. Anyone can buy Facebook, and if it goes lower than yesterday's low, you sell it. You have downside protection. Anyone could go buy Lucid, and if it goes lower than yesterday's low, you sell it. Now, that's if you're trading stocks, right? Because then you know your risk. When you're trading options, it's a little different, because options, you don't know your risk. Well, you know your risk, but to calculate the risk is much different than calculating the risk in a stock. In a stock, say, for instance, I buy a stock at 11, let's say I buy a stock at 10, and if it goes, and I only want to risk 10%, well, then I can do the math. 10 minus 10% equals 9. Okay, if the stock goes under 9, I want it to be sold. I now own a stock. I have a 10% risk in it. If it goes under that, I'm out, which means the most I could lose is 10%. And I'm going to allow it to go to kingdom come, right? So 10% down, infinite up. Sounds good, great. Especially when that 10% down is a reference point. Well, it went down as low as 9 yesterday and it rallied back. Therefore, I can go ahead and say, if it stays over 9, I'm comfortable owning it. Cool. How do you do that with options? Now, for those that are new, and I see that we have a really, really big group today, options are a little different, right? Options is your not gambling, I keep saying that. You're counting cards. But you're betting a stock to be a certain price by a certain date, and the value of that option is dependent on the magnitude of you being correct. Because if you're wrong, the option goes to 0, right? So say, for instance, I'm betting a stock to go over 25 by next Friday. And I say to you, hey, listen, I'll bet you that stock goes over 25. And if I'm right, you owe me every dollar it is over 25. But if I'm wrong, it's going to go to 0, because why would you buy a stock at 25 from me when you could buy it in the market for 24, right? Like if it's under 25. So I'm making an all-in bet. I'm either going to make money or I'm going to lose all of it. That's what options are. So you say to me, well, hey, if the stock's 24 now, you think it's going to get to 25? All right, I'll I'm going to charge you $1 for that then. And I say, okay, in my head, I do 25 that I'm betting on, plus $1 you're charging me. So it's 26. So the stock has to go over 26 for me to make money on it. It's now 24. Okay, cool. I think it's going to get to 30. Now, if it gets to 30, and I'm able to, and you have to buy it from me at 20, or I get to buy it from you at 25, what's that worth? Each contract is now worth $5, right? If I can buy this from you at 25 and it's really worth 30, then 30 minus 25 is 5, which means the $1 you charge me minus, so the $5 minus the $1 you charge me is $4, which means I just made 400% of my money. That's how options work. You could make a whole lot of money and you can lose it all. So how do you go ahead and manage risk with options? So that's a different story, right? So to manage risk with options, it's a whole bunch of, I own this stock, but I'm hedging it by selling these calls, and I'm using those calls to finance buying to put underneath, blah, 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 right? A whole bunch of stuff. What we do, and by we, I mean me, I go ahead and do all of the work possible to put myself in the best position to identify a high probability, profitable opportunity. So if I see something where it's 25 and it could go to 27, well, I'll just buy a call option on it. I'm buying that this thing is going to go up. And that call option, depending on how quickly that stock moves, will go up to that magnitude. Maybe it'll go up 10%, maybe it'll go up 20%, maybe it'll go up 40%, right? Because they move so quickly, because it's simply just saying this stock by this price, and the value of the option is how far are you from the goal price, right? If you're saying 25 and the stock's 22, well, you don't have any value there. It's not worth anything. But if you have a week to get there, well, that week gives you time value. It could still happen. I got a week still. Now, when that week turns into 2 days, what's the value of that option? It really came in because you only have 2 days left. It has to happen in 2 days. What happens if it doesn't happen? Well, there's no time value. There's no intrinsic value. The thing's worth zero. Conversely, let's say the stock goes to 30 tomorrow and I still have a week and my goal was 25. You know what the price of that option is? The $5, right? 30 minus 25. So I'm $5 over my goal. But I still have a week to get more and more and more. So maybe that week is worth $2, $3. Maybe the whole thing is worth $7, $8. I only spent $1 on it. So I'm 8 times my money. I like those percentages, right? Like I like making 30, 40, 50% on trades. But in doing so, there's different rules that go with it. For me to reliably and with such regularity make that type of money on trades, I cannot just be trading every day. I can't just say, I'm bored today, let me go buy this. I can't just say, oh, you know what? I haven't made a trade in a week. I'll just make one. Because remember what the other side of that bet is. Yeah, I can make 40, 50, 100%, but I can also lose it all. And there's no nobility. There's nothing cool about somebody that has such an itch to gamble that they've accepted losing all of their money. So you have to have a certain emotional fortitude. You have to have a tolerance. You have to have a discipline about yourself. So what does this all mean, right? And we're going to go to the charts. But yesterday, when we saw those stocks at those prices, we said, all right, let's see what it happens, because this is going to tell us stuff about the market. Let's see, been there, done that, right? Like, let's see what happens. What does this tell us about the market? And hopefully, what we were hoping for is that the market ended up down yesterday and opened up down today, in which case we had enough confidence because we saw enough that if we were able to buy those things right today while they were down, we would have loved it. We'd be dancing naked in the streets by the end of the day. But that opportunity didn't come. But if that opportunity did come, do you see that we were in position for it? You can watch yesterday and see that that's exactly what we said. You can take a look at our account and see it's all in cash. We were ready right now for that moment, which means stocks open up one of two ways. They either open up or they open down, which means we put ourselves in a position that we had a 50-50 opportunity today to make a very big amount of money. Now, just because the stocks opened up positive and we weren't able to capitalize on that opportunity, do we sit there and say, oh gosh, darn it, gee, whatever. We should have went ahead and gambled yesterday when we weren't so sure. No. If I have a 50-50 chance of something happening today, that if that something happens, I believe to myself, I have a 75, 80, 90% probability of making 40, 50, 60% of my money in a matter of a day or two. That's all you can ask for. You have to have a certain level of discipline. What we did today was great. We put ourselves in that position. Just because that ball didn't roll green and it came out red or it came out black is not the argument. That is not the problem. You can look back and say, oh, but we should have done it yesterday. Yeah, you should have if you knew what was going to happen today. But you did not know because nobody knew, because today is happening now. And if today happened the way we asked, could it happen this way? It's very heartening to see that the market reaction today is confirming what we believe the market reaction would have been. It just happened sooner than we liked it. Therefore, our belief and our forecast of market reaction was spot on. The stocks we wanted were spot on. Everything was spot on, except we just didn't get the opportunity. We had a 50-50 chance of doing it, and we didn't get it. That's fine. If I could walk into moments and 50-50, I get an opportunity that's going to be profitable 80, 90% of the time to 30, 40, 50%, I'll do that all day. I'll live my life like that. And that's how a trader works. That's what you're looking for. You do not tell the market what you want. You read what the market's telling you and accept what it gives you. But are you ready for it? Will you be there when the market gives it to you? We were here, right? So let's go ahead and take a look at the chart, see what's happening today. Let's see if we could go ahead and put together a thesis going forward. Let's see if we can identify a next opportunity. But just because our account doesn't say we made money today does not mean today's not a good day. Everything that we said, everything that we projected, everything that we forecasted is happening right now. That's a good thing. That means we're right on it. That means that if we're able to continue that line of thinking, that means that the market's not tricking us. That means we can go ahead, like the matrix, see what's going on. And the next opportunity that we identify, odds are we're going to be correct because we had the entire story correct. So as long as we continue being diligent and making sense and offering great research, it is conceivable that the next trade we make is going to be a very good one. And I love that. I just squeaked, right? So let's get into it. I love all of you, by the way. Okay, so let's go to share screen. Oof, get so excited. You guys get me so excited. I can't, oh my God. All right, let's not look at that yet because I'm gonna throw my computer out a window. The market's doing good. So let's take a look, right? I feel like I know this girl. I think I dated this girl. I don't know. All right, the Dow is up 0.8%. The S&P is up 1.21%. Now let's talk. What does that mean? The Dow is the trophy assets of the nation. The Dow is complete. The large money flow in the Dow is international money flow. So when other countries are sending money to the US, they put it in the Dow because that's the trophy assets of this nation. Sorry. Okay. So when a market is going down and you see the Dow going down less than the other indexes, it tells you that there's money flow coming into the market that's looking for a place to park, that there is money out there that's looking for the opportunity on a sovereign level. That is step one. That is good. And if you've been with us for over a week, you knew we identified this when the market was going down. Okay. What's the S&P? 1.26%. Why is that important? The S&P is how every hedge fund and private equity fund and stockbroker and mutual fund measure their performance, because the S&P is the 500 largest companies across the globe. Therefore, if you can just buy the S&P for free, right? As an investor, I'm diversified. I bought the S&P and you can make 10% in a year. Well, then why would you ever give money to a stockbroker or a money manager that only can make you 8 or 9%? That means they underperform the benchmark. The benchmark is the S&P. Therefore, when you see the S&P doing well, that's professional money actively being managed. That is pension funds, not pension, maybe mutual funds, private equity funds, hedge funds, all taking stock, well, not stockbrokers, they're dirtbags, and I'll tell you why in a minute. But the professional money managers are all taking money and throwing it into the market and picking their stocks. So when you see this doing well and outperforming the Dow, you know that money's coming off the sidelines for mutual funds and stuff. Now, the NASDAQ is the dirtbags I was telling you about, right? So those are the stockbrokers and the retail people. And I shouldn't say dirtbags, it's kind of me, but I just have a very poor opinion of your retail stockbroker. I think, and because I know the environment, this is what they do, right? They study really hard for their Series 7, they get their license. While they're studying, they're working for a senior broker. They're called a connector because they can't pitch anything they're not legally allowed to. Hey, is Mr. Jones there? And the secretary picks. No, Mr. Jones says, this is Ted. I need to speak to him. Hey, trying to confuse the secretary. Just kidding. It's about vertical integration. He'll know what I'm talking about. Just tell. Yeah. Can you try to confuse the secretary the whole time? The second they get the person on the phone, they go, okay, Recco. And they get the head broker to get on and say, yeah, Mr. Jones, we've been trying to get you. You have to hear this. I have something that warrants your attention right now. Grab a pen. And that's how that industry works. So the onus is not on intelligence, it's on salesmanship. The onus is not on integrity, it's on short memory, because you're going to lose people money all the time. And that's not really what you care about. You just want to keep that door going because you make commissions on these people. So when you go ahead and pitch someone a stock, well, if I called you today and said, guys, listen, have you ever heard of the company Kellogg's? Yeah, they make the cornflakes. It is one of the most exciting companies out there. You have to get into it. We believe grain prices have hit their high, which means their margins are going to increase. And we believe you can make a good 5% on your money over the next year. Does that even sound sexy at all? You're going to say, Anthony, even if you're right, that's not enough for me to get involved in this. Goodbye. And that's discounting that you even want to talk to me. So a stockbroker, when they call you, hey, did you listen to AMC? Yeah, I know with AMC, it's the movie company, but they're now getting into NFTs and they have a short interest. You remember what it was back in 2020 when it went to $100? That's brewing. We could feel it. We see the volume. We see the on-balance volume. Every indicator tells us $19 today is going to go to at least 100 within a year. But if I'm only 10% right and it goes to 30, then would you be upset? No. That's why we have to take a position in right now. Grab a pen. What's your social security number? Oh, Anthony, I'm not buying this. Mr. Jones, if I'm able to deliver this to you, would you go ahead and work with me on future deals? What I'm trying to do right now is establish a relationship that you can go ahead and judge our future ideas on based on the performance I'm going to give you right now. Listen, I understand you don't have $1,000, you don't have $10,000. Buy 100 shares. Give me $100. Give me a little vote of confidence. And if I can show you this performance, promise you'll work better with me down the future. Okay? Well, this guy won't get off the phone. He sounds wildly excited. If this thing goes up 1,000-fold, I made a lot of money. And if he's telling me it's going to go up 1,000-fold and only goes up 100-fold, I still made a lot of money. So you know what? I'll try this guy out. I'll give him $100, right? Okay. That's stockbrokers. I was a really good one at one point, right? Like imagine that ability to talk while actually having integrity. Now I do that for you here, right? So, well, like I'm excited. I miss being on the phones. Anyway, but you can see I have a very poor opinion of them because I know what they do. And everything that they say is in a book. It's called the sales book, right? What's it called? Sales 1, 2, no, the cells. You know, Mr. Jones, if I had been your broker over the last 10 years, giving you regular outperformance, would you be questioning me on this trade right here? And the client obviously says no. Well, that's what I'm trying to build, a long-term relationship with you. Give me this trust on this one idea, and I promise I won't let you down, okay? And it's like, after they say no to that, then you go to page 2, and page 3, and page 4, until you get up to page 10. If the person did not hang up on you by page 10, they're going to buy something. They have to. But if they hung up on you, everyone in the boardroom starts high-fiving. Yeah, you took that MFR down to the mat. Good for you. Next call. That's how stockbrokers work. And for them to even share a story that has that type of sex appeal, they go to the NASDAQ to do it because those are all your high-flying, super exciting tech companies. Now, the Russell 2000 is all your smallest companies. These are the companies that are the most economically sensitive and or the most prized, or not prized, but the most obvious takeout candidates because they're a low dollar amount. So, and this is the VIX, which is the volatility index. This is how people are feeling. So what does this tell us? If we just look at these numbers, again, you need to be better. You need to be able to read the market. What does this tell us? Okay, international money flow is there. but the money managers are really the ones that are super excited right now. The stockbrokers are jumping in left and right. Now, if we could go ahead and share that story about stockbrokers, one could say that they're the least intelligent on that list of people. So if they're the ones jumping in the most, is that good? Is it good that the least intelligent people are leading the party? Now, that doesn't mean it's bad. It means it's bad more times than not, right? It means if you follow the least intelligent person 10 times, you're probably going to get to the wrong place 8 of them. But 2 of the times, they might just get there by accident, right? They might just been first. Because they're least intelligent doesn't mean that they're wrong. It just means that they do not care about risk. They're unintelligent to the risk that they're taking. Therefore, these are the guys in the army that are running in first, right? And God bless, right? Like, we love our armed forces. I don't want to say anything bad about army. Let me make a different example. These are the ones that are just running in first. They're the ones that are going to take the heat. They're the ones that are going to lose money first. But these are the ones that are going to make the most money. And if you're the client that goes ahead and gets involved with them when they got lucky, then you're great. If you're the client that got involved with them while they're just, doing their spiel, not so good. So this is a bit concerning because we don't want to follow these people. We know that they're going to be wrong 80% of the time. Now we see these people are outperforming the day, right? Like, so they're right with the NASDAQ. And these people are the small companies that either are sensing the economy is going to do better, which we already know to be the case. We already did our inflation analysis yesterday. We know, we can't say we know, we firmly believe stocks will be up by the end of the year. And if that's the case and you're a large company and you want to put money into stocks, why wouldn't you be buying some other companies? You better get them now. So honestly, this looks good, right? The small companies are outperforming. The stockbrokers are getting everyone excited. The money managers are getting in there. And the people that are being the most cautious are your sovereign equity guys that have the most money anyway. And they by nature don't take a lot of risk to begin with. Now, what are we missing? We have price. We have volatility. I could hear someone saying it. Volume. None of this means anything. All of this that I've shown you, how many people are trading? You don't know. Is this accurate if I were to tell you only 3 people in my basement are trading stocks? Well, you would say, yeah, that's crazy. That's not a market. That's 3 people in your basement. Yeah, that's what the volume tells us. The volume is the lie detector test. We need to see if people are actually trading this. Is there a large amount of investors that are participating, or are people sitting on the sidelines saying, I don't know what these people are doing. I guess let them do whatever they do. We want no part of it until we see what we need to see. Now, of course, a lot of that was very vague, but it's like, try to think of an example, right? Like, say, for instance, okay. So when COVID happened, nobody wanted to get on a cruise, right? You're trapped on a boat with people with COVID. So the cruise lines came out and went ahead and offered reduced prices. Now, there were people that bought those reduced prices. I remember was it Royal Caribbean? And then the COVID thing happened again, and the ship was stuck at the harbor for like 2 weeks or whatever. And those people that bought those tickets are like, oh, that was so stupid. The tickets were like $50 and duh, here's why, look what I walked into. Now, the next people that bought the tickets for $50, that didn't happen to them. So they were able to say, thank God that didn't happen. Woof, that would have stunk. I got a great deal. The next people that bought, say, the $75 tickets, that didn't happen to. Woof, that was a great deal. How many of those boats have to not have an outbreak for someone to have a trust level that it's not by luck, but it's by design, that this company figured out how to make sure that their boats are safe? Well, I don't know the number, but I know maybe 10 or 15 or 20 cruises later, those prices went up to $200, $300, $400. I know more people bought the $400 tickets than people that bought the $50 tickets. Anthony, that makes no sense. Why would more people buy it at $400 than they would at $50? Confidence. You need to see that your money is not going to go ahead and be thrown. It doesn't matter how cheap something is. If it doesn't work, it's worth 0. So if it charges you $25 or $200, it doesn't matter. If it doesn't work, it's worth zero. Therefore, if I know to myself that at $400, I have a 99% certainty of this thing working, I will take that over than buying it at $50 with having a 50-50 certainty, because I don't want to take on that level of risk, not with my health and not with my family's health, because it's a pandemic. And at that point, we thought we were all going to die, right? So let's take a look at the volume. Okay. So here's the market. Now, the reason we're on Lucid right now is because look how high this got, 28.70. Look how low this got yesterday, 25.90. Do you know what $3 is on a $25 stock? I'm thinking about it. So 3 goes into 25, 8 remainder 1, 8 goes into 100, I think 16 times, right? No, 16%. 100 divided by 8 is 16%, I think, right? 12.5, sorry. So the stock moved up 12.5, 13% in a matter of 24 hours. Now, if you were to have bought calls on that, right, like options that go up when a stock goes up, and you bought it at this point where we were talking, then they were probably really cheap, right? Like let's go take a look, right? So let's log in. Let's do some investigation, as they call it. And you can see we own nothing. We just have cash sitting around. Okay. So this will be fun. We'll play the woulda, coulda, shoulda game. So let's go to options. Now, if we bought the options yesterday, when would we have, well, how long would we have bought them for? And I would say a month, right? We didn't have any reason to buy it near term. We thought we were getting close to a bottom. We would have given us a month's time, right? So that would have put us, what are we in? February? That would have put us in March. Okay. Right? No, these are the margins. Okay. Click the button today. So my computer wants to be a little slow, but that's okay. Anthony's not going crazy yet, which is a good thing. Anthony feels, okay, there it is. Okay. So it was 25. So let's say we would have done, would we have done the 30s? Probably. Now, Anthony's really cautious. At 25.80, let's take a look, right? So it was over here. We would have said maybe it gets back to this area. Okay. And we would have said this area because you could see the channel. You can't see the channel. Let's make the channel. I saw the sign. It opened up my eyes. I saw the sign. Who remembers that song? Great song. Okay. So here's the channel. You can see it's trading in it. When it went over it, it went above it. And then when it went under it, it went under it. I know that sounds overly simplified, but you can see this is its trading channel. You can even see that it bumped its head over there and it came back down. So what's this trading channel? It's the low point of this day, which the low point is 28.39, and you can see it up here, right? So we would have said, let's buy the 28.50s, if there's 28.50s. Otherwise, we would have done 28. Okay, 28. So let's see the trade details. Okay. Can we see what it was yesterday? All right. So 5-day price. Yesterday was the 8th, right? Do you guys remember what time we were talking? I do. We start at 10, we go to 11. So at 10 o'clock, 10:15, this, give me the option price, you Momo. All right. At 10:15, the option price was 275. Do you see that? It's right up here. At 10:30, the option price was 265. Do we see that? Right over here. Okay. Now we would have bought it and put a 40% sell on it, right? So what's 40% profit on 265? 371. And we would have had that sell order in. And then what happened this morning at 9:30? Got to 380. We would have sold it. And we would have sold automatically. So our 40%er was right there. We were on TV together talking about it, highlighting it, and saying, do we want to get into this right now? Right? So it was there. Now, the reason we didn't, because Anthony, like, it's easy to celebrate something you didn't do, like woulda, coulda, shoulda. But why didn't we do it? Because we needed to, everything was still going down. We needed that one more day. We needed to go ahead and see Facebook stop going. We needed to see PayPal stop going down. You know why? I'll tell you why. Because you see this, it's a trough, right? It's a low point. And it looks really sexy because it stopped going down. What about people that thought it was that over here? Boom, boom, boom. What about people that thought it was over here? Boom, boom, boom. What about people that thought it was over here? Boom, boom, boom. What about people that thought it was over here? Boom, boom, boom. Right? The point is, you can be a cowboy and say, okay, I'm going to buy it here. I'm going to buy it here. But what gives you the confidence to know that it's not going to go any lower? Because I can promise you, you might have thought you were really cool over here at 370. But I can promise you yesterday, when you're down 30% on your money in 3 days, you're not happy. We do not like being amongst those that are not happy. We like being happy. Therefore, we will go ahead and make sure that when we step into something, we know what we're doing. We want to mitigate the risk level. So what did we say? Check the end of the tape. Guys, we hope the market closes down today, and by continuation that it opens up down tomorrow, because I'm having trouble. That's because someone's talking to you, Siri. Because we are buying this tomorrow morning, which means there was a 50-50 chance of us buying it today, whether the market was up or down, which means imagine if the market was down, we would have got this price, if not better. Now, what did we see? Were we right? Yes. Because look what the market did. It just did it a day earlier than we wanted to. So if that 50-50 chance worked out, and if we were able to buy it this morning, it's conceivable to say this would have been the outcome. Meaning we had a 50-50. We walked in today giving ourselves a 50-50 chance of making 40% on our money within a matter of hours. That's a win. I will take that every day of the week. And I bleeped out my curses, right? My wife always says, Aunt, just because you bleep them out doesn't mean you didn't curse. Like, we can read your lips. In which I say, compromise, babe. Marriage, we got to compromise. But her point is just, that's how I share my level of passion, right? Like, this is a real game. And people that go ahead and disrespect this game or just lose people's money, like, I got an email from one of our rhinos that showed me that somebody that we know said that they paid someone $50,000 to teach options. And I know none of that to even be the case. And if that individual had paid $50,000 to learn options, they're cuckoo for Cocoa Puffs, which means it's all a big marketing ploy, which is it's nothing more than a person getting on the phone saying, you got to buy this here. You know who that person is? I'll show you who that person. That person's this person. Oh, the market's going up. Let me go ahead and tell everyone to do options. Where were they when the market was going down? Because if you think the value is that when things are going good, I could stand here in front of you, but I'm unable to forecast when things are going bad, or I'm unable to mitigate things going bad, or I'm unable to navigate you when things are going bad, that's the value. My wife is a 10 out of 10 when things are great, but when things aren't going great, she's still a 10 out of 10, and that's the value of her. Because if things are going great and she's great, well, cool. Well, if things are not going good and now you're miserable, what good are you? The point is, and that's who you marry, whether it's in relationships, marriage, investing, partnerships, the person that's willing to be there with you, to put their neck out there and say, I'm with you every single day. And if something's not going perfect, we will be there and we'll figure it out together. Wow. Gets me all, because I can't stand people. I just can't. Like, so many people love taking advantage of everyone, and it's so disgusting. All right, so anyway, let's go do some actual homework. It's now 10:54. Don't you love when I'm like, oh, not going to talk that much today. We're going to get right into the charts. All right, so let's take a look at the NASDAQ. Let's put our volatility indicator on. All right, and see what's going on. Okay. So actually, let's take a look more over here, right? Because, okay. So this is where we're coming from. Is that the recent high? So let's leave it here. Okay, cool. So we're gonna have a little fun. Let's do some trend lines. This looks like a good one. Okay. Now, why did we make that line? Because that line's the top, and that line connects this top. Can you get out of my face? That line connects mostly that, but once it got over it, you saw the market go up. Once it got over it, boom, boom, boom. And then once you saw it got underneath it, it never got over it again. In fact, it tried, it bumped its head, went lower, tried, bumped its head, went lower. Couldn't even bump its head, went lower. But once it got over it, ooh, we're over it, cool. Oh no, we can't hold it, boom, boom, boom. So we can see that this line is quite important. It has a certain power to it. Okay. All right, these guys gotta go. You know, I really wish there was like an erase button. And I'm sure there is. I'm the guy that still thinks the iPhone only does text messaging. I don't know that it actually rubs your belly while you eat. And I'm not sure that it actually does that, but it's closer to that than doing nothing. Come on. All right, so let's clean this up a little bit, right? I don't know about you, but for me to work properly, I need a clean environment. And that goes for this as well. All right, so let's delete this. So let's put the trend line underneath it. Where are we going to go? This looks like a good one, right? Now, by the same count of what we did, you'll see that how we did this one. This is this top. Well, and you can't just pick a top. Well, duh, but you have to make sure it connects the tops. It's like, remember in preschool where you had connect the dots? That's this. So there's the top. And then once it got over, that became the bottom. You see? Now it became support. It was resistance. Now it's support. Support, support, boom, goes up, bumped its head, you know, did that whole thing, bumped its head, but look where it fell. So support, bumped its head, where did it fall? Support. Bumped its head, where did it fall? Support. Bumped its head, oh no, we went through a support. Oh no, boom. So you can see this line was very important as well. Okay. You can see this line was very important. We made this together. This is a trend line. When it broke out, look what happened. It went higher, right? And you can see that this was support underneath it. All right, so we got those things down. So let's go ahead and erase that because they already happened. Okay. It's now 10:57. If everyone's okay, I'll go to like 10:15. I just want to get this. Let's just, because again, this is a real program. Like I'm doing this for myself and I would be doing this whether I was on with you or not. So if you want to hang out a little bit longer and watch this, I would love to have you. All right, so what do we say? Well, what if we drew this trend line over here, right? Now it looks like it's something, so we got to make it perfect, right? Let's connect the dots. So that connects these dots, right? Oh, cool. Thanks, Kenny. All right. All right. So it looks like this was resistance. Now, where are we? We're above that. So that's a good thing. All right, let's see if we have a support line somewhere. We want to connect these two dots, right? Okay. All right. All right, so we can see that it broke out on this downturn, on this downtrend that it's been going through since January 4th. It broke out over here, but it was a false breakout and came right back down. It broke out over here, but is it a false breakout or is it going to move higher? Because conceivably, now you have your reference points. If this stays broken out, this is your support line. If it gets close to the support line, you want to be a buyer of it. If it breaks this support line, you want to be a seller of it. This is how we go ahead and build to go ahead and be able to walk into another 50-50 opportunity. And 50-50 in terms of being able to identify 100% opportunity, right? It's not like 50-50, well, stocks go up or down. That's not really anything great. No, 50-50 in terms of, can we walk in one day and say, all right, it's right on the line, guys. If it holds this line, we can buy it. If it breaks this line, we can sell it, right? That gives us something's going to happen. It's actionable. We need to walk into an actionable opportunity. All right, so that is a support line. Now this is a resistance line now. We've seen it bumped its head and fell. So if this starts moving higher to here, now we will say, is it going to break? If it breaks that line, we're going to buy. If it bumps its head on it, maybe we sell because we think it's going to pull back. And if we sell, maybe we sell it because we believe it'll get back to this line, right? We have reference points now. That's a good thing. It's like being a ship captain in the 1400s. If you do not have a map, you have a problem. We now have a map. A map is good. And we see dragons and all the rest and whatever. So let's do our price, volume, volatility. Okay, let's start back here. Actually, let's start here. So we see price going down. We see volume going up. We see volatility going up. That is the trifecta of that's bad. Because price is going down, but more people are selling it at lower prices. They're not abating. There's not people coming and buying. They're still selling. Everyone's getting really scared. Look at the volatility going up. Okay. Now it's even, right? It's sideways. What happened with the volume? It's down. And what happened with the volatility? It's going down, right? Okay. So people are becoming less volatile. There's less participants, and they're just there, right? Like, all right, I know everyone's not here anymore, but the ones that are here, we feel good about it. We could defend this. All right, cool, good for you guys. But there's less people, and they feel comfortable. They're like, hey, we're feeling kind of good today. Things are going fine. Well, when you have a whole bunch of like the last man standing feeling good, and stocks start going up, how do they feel, right? Guys, we got this. And the fact that they did get it, how do they feel? Well, they feel really good. Look at volatility going down even lower. But this is going up with even less volume. That's not good. That means that even as this is going up, people are selling. They don't even want to be a part of this. They're not buying this because they're like, hey, this is like the start of something big. They're like, I just witnessed this. Yeah, we got a little bounce. Get me the out. I want nothing to do with this. Okay, cool. You still got these people. They're like, guys, everything's cool. Yeah, man, everything's going to be all right. I tell you everything. It's going to be good. And those people are just really just chilling. Look at them. They're even becoming less volatile again. And what are they doing? They're just sitting there. They're sitting sideways again, right? And what's happening with the volume? It's going even lower. There's less people there. Okay. Well, the volume yesterday was higher than the volume the day before. Look at this bar. It was an exciting day. A lot happened, right? Like it opened up at the lows and closed on the highs. That catches people's attention. So we have volume going up a little bit, right? So let's say volume went up here. And that's very micro. That's one day over another day. And it's not even by much, but it's a start, right? It's a start. And in that, the market went up, right? It closed there, it closed there. Okay. So the volume went up, the market went up, and the volatility went down. That's very good. Market up, volume up, volatility down, you buy. Well, look what today was, right? Duh, there it is. Now what happens? This is quite important. If this volume today is higher than this volume, and more people come into the market because this broke this line, we will buy tomorrow. We will buy and we will sell up here because we believe that if more people believe this move to be true and they start piling in and we see 2 days in a row of higher volume with lower volatility with a map in front of us, we will buy. What are we going to buy? I don't know. We'll figure it out, right? But this gives us an opportunity. If this volume is lower, then maybe we start looking at, does it break this? Maybe we start taking a look at shorting this. Maybe we say that it's not time yet. But as you can see, we're getting close to a picture. Now, the difference between waiting to see the picture and putting your money on what you think the picture might be is one is gambling and one is investing. So we offer this research for everyone to do what they feel is best in their heart. I've got emails today saying, Aunt, stinks that you didn't buy Lucid. I did. I got emails saying, hey, Aunt, got into Facebook. I got too low. That stuff did happen, right? So for those people, God bless, you did well. For me, that was too much risk for my money. I'm not willing to take that level of risk. So what are we looking at? We believe that this volume is going to determine what our next move is going to be. Now, in terms of things that are going on in the market, tomorrow you have a CPI data. That's consumer price inflation. Everyone that's going haywire about the Fed raising rates, it's all based on inflation. The number one inflation indicator is the CPI, Consumer Price Index. That's the rate of change of prices year over year and month over month. Meaning, if that number is super high, people are going to be like, oh my God, the Fed is definitely going to raise rates, and the market will start lower. If that number is low, people might start saying, wow, inflation's kind of coming down by itself. I don't think the Fed really needs to be as aggressive as they're talking about. The market will start higher. We know that. Here's something you don't know, though. If that number is hot, right, it's high, and the market starts low, and throughout the day, the market continues to move higher, then that tells you we hit a bottom. Because that is the worst news a market could get, and it went higher. Which means, here we go again. Here's our 50-50 proposition. If that number comes in hot, and if that market starts down tomorrow, we will buy tomorrow. We are going to buy stock tomorrow. Because if that market is down, something we believe is a non-event that's already priced in because of everything we're seeing. Now, mind you, people that enter the stock market take a look at charts. I'm a chartist. I'm taking a look at charts. Everything that we're saying to you has a foundation, has a history. Everything builds to the next day. We've been in this market seeing how it reacts to news. We've seen it react to Lucid yesterday. Do you think any chartist looking at the QQQs has a chart of Lucid next to it, and it has right next to that the research report from JP Morgan? They don't. You know why? Because you can't just do this on a chart. Everything has to lead up to it. Meaning, we've already seen enough examples of corporations buying corporate stock and companies that are worth zero going up, and companies getting bad news still going up. Chipotle is up like 100 points today because they said they could raise prices if they have to. Not even that they did. We could if we need to. When that starts getting stocks up, you're really, like if you want to buy stocks, you probably could, right? But I would love, because we do options, a market that's down. If we can get this market down tomorrow, say for instance, the market opens up down and it's right on this line. Could you imagine that? That would be Anthony's putting all of his money in, right? Like that's a great scenario. So knowing what we know now, have fun today. Go enjoy, live your best life. We now have a map. We know that today would have been uber successful because it was right in front of us. We were able to go ahead and confirm that we would have been uber successful. The only reason we weren't is because we know the difference between investing and gambling. And we will not gamble with our money, especially when other people are watching us. Therefore, we are now having another setup. Everything that we could have had today is now able to happen tomorrow if that 150-50 proposition happens. So everyone, put your inflation hats on, go outside, get really excited when you see shampoo at $10 a bottle, because if those inflation numbers come over 7.5%, 8%, and this market starts down tomorrow, get your buy pants on because we are buying some stuff. Whew. All right, that was exciting. Let's take a look at the super duper list real quick. Oh my God. Look at Lucid. This was $25 yesterday. Ugh. Well, what was this? Okay, so remember what we talked about? Anthony buys 16 red and greens, but it's not always the best thing to do. 16 red, green, up 4% the next day. When I spent 20 years making this algorithm, and not 20 years coding it every day, but everything I've learned in 20 years is inputted into this. It wasn't by accident. It just wasn't. I look at stuff like this and it's a good feeling, because this is hard work right in front of you. Like, you could watch CNBC, you could call stock, none of them have this. It is conceivable, and I actually would defend saying that we are the best platform that exists because no one else has this. Anyway, Caterpillar, 15 red and green, boom. Remember when we were talking about it? This was Friday, right? I think. And we were like, oh, we really want to buy it. It's Caterpillar, it's the Dow. Oh, it was 196. It's now 204. The only lesson that should be taken from this is don't kick yourself that you didn't make money on something you believe you could have made money on. Congratulate yourself that you have the discipline, because it could have easily gone the other way. And we mentioned Kellogg's before, because I know it's a 15 red and green. But it's not, I mean, you would say, look at this move. This is 67, this is 61, right? It doesn't move a lot, but it's a 16 red and green, right? So we have it. This one, remember yesterday we said this is a 19 red and green, that it only missed it by 10 cents. And that's because we know how we calculate this. 157 to 164 overnight. That was a nice move. PayPal got as low as 118 yesterday. Facebook. We have to see what goes on with it. I still think Facebook is ground zero. Facebook is such a large company that everyone owns it. Every mutual fund, every pension fund, every hedge fund. The lower it goes, the more they have liquidation, that they have to do margin calls. So it's conceivable that Facebook will lead this market. But again, you have a reference point in Facebook. 217 was the low yesterday. It got to 227 today. Do you think it goes straight up? Or does it pull back and maybe go down to 221, 220, and then people buy it there? And then that's called a successful test. It didn't get to 217, but 217 held because it got to 221 and everyone bought back in, and off to the races you go. So Facebook looks really sexy. I don't know if it goes down to 221, but if it does, I'll buy it. So there you go. Oh, remember we talked about this, IWM? Guys, so I'm getting a little, because we nailed all of this, but didn't buy any of it. And you know why this is on the super duper list right now? And it wasn't on yesterday? Because during the day that I saw Chipotle reports earnings, and I love Chipotle, because no matter what, and we've mentioned this, people wait outside for Chipotle. And I didn't want to be irresponsible and not dog whistle, but post in the group, hey, Chipotle reports earnings tonight, let's check it out. Because again, that's purely gambling. I did not want to go ahead and provoke anybody to feel comfortable. Oh, good, they report, it has the Anthony endorsement, it's gonna go up, I'll risk money. Because if you play in options and you do an earnings, it can be worth zero the next day. But the reason it's here is because I put it on the list during the day because I was thinking about doing it. And it's only because I took an extra level of risk, or I guarded against the extra level risk, is why I didn't say it. But the reason I'm pointing it out is because you guys didn't see me type it, right? Like, it's been here. It wasn't there yesterday, which means I did put it in during the day. So I'm feeling quite confident. We're spot on with what we're looking at, which is a good thing, because if tomorrow we get our point and we make 40, 50, 60% on $26,000, am I happy? Yeah. Are you happy? We're all happy. All right, so that's that. Let me go ahead and stop the share. I know I have questions. Thank you, Anthony, says Don. Frida, it was an interesting Zoom. Thanks. Bobby, thanks. No, guys, honestly, it's seriously my pleasure. Every day that you're here with me is a good thing. For everyone, I will be doing 2 o'clock RHINO today. And it's funny because this is now RHINO Wealth TV. I like the way that sounds. And for 2 o'clock RHINO with V, it's like, okay, we have RHINO Wealth here. It doesn't sound, it needs something behind it. So I think with V, it's now RHINO World TV, because she's going to cover any and everything. She is going to be your front lines of all updates RHINO. So RHINO World. So I will be hosting RHINO World today at 2. I hope to see you there. If not, smell you later. I will see you tomorrow. Let's hope for a very high CPI number. Yeah, V's amazing. She's seriously super duper duper. And everyone knows super duper duper means a lot to us. Super duper duper. Anyway, we are hoping that we get a super high number. We are hoping the market starts low tomorrow so that we can go ahead and take advantage of it. In which case, I don't trade before 10:30, but if this market starts down big time, please pay attention. I will post in RHINO Wealth, the Facebook group, if I decide to purchase something before our live starts at 10, because I might have to, because I do believe if that number starts low, people are going to rush in to buy the market, and I don't want to wait. So tomorrow I would buy early, so I'm sharing that with you now. All right, cool. Everyone, totally love you. I will see you later. Bye.